Hi, I'm Rafi. Welcome back to English Learners. Today we'll talk about money, the stock market, and the money market, and I'm here with Raha.
Hi everyone, I'm Raha. I'm happy to be here with Rafi. Today we'll explore how money works, why people invest, and how the stock and money markets affect our daily lives.
Let's start simply. Why do people invest? Some want their money to grow faster, while others want safety. How we handle money depends on our goals and how much risk we can take. For example, if you want to save for a house in a year, you might choose safer investments like bonds or money market instruments.
Yes, and if someone wants to grow wealth over many years, they might invest in stocks. Stocks can rise or fall, but over time, they often increase in value. That's why it's important to understand concepts like bull and bear markets.
Right. A bull market happens when stock prices keep going up for a long time and investors feel confident. For example, during the last 6 months, tech stocks kept rising and people were optimistic.
On the other hand, a bear market happens when stock prices fall for a long period and people feel cautious. For instance, last year, many energy stocks lost value and investors became nervous.
Volatility is also important. It tells us how much prices move up and down. A highly volatile stock can change price quickly. For example, some small tech companies can rise 10% one day and fall 8% the next.
Exactly. That's why people create portfolios, which are collections of investments like stocks, bonds, and money market instruments. If one stock falls, another might rise, keeping the portfolio balanced. For example, I have a portfolio with tech stocks, government bonds, and treasury bills. It helps me manage risk.
Speaking of bonds, they are loans you give to companies or the government. They pay interest over time. Some are very safe, like government bonds. Others are riskier, called high-yield bonds, but they pay more. For example, I bought high-yield bonds from a new company. I know the risk, but the returns are higher.
Liquidity is another key term. Liquidity means how easily you can turn an investment into cash. Money market tools are usually very liquid, while stocks and bonds can vary. For instance, if I need money for an emergency, I can sell treasury bills quickly without losing value.
Now let's talk about the money market. It deals with short-term lending and borrowing, usually from overnight to a few months. It helps banks and companies manage daily cash. For example, a company may invest in certificates of deposit to earn interest while keeping money safe and accessible.
Yes, and central banks influence the money market. They adjust interest rates to control inflation. For instance, when the economy needs a boost, borrowing becomes cheaper, encouraging investment.
Dividends are also important. Companies sometimes share profits with shareholders. For example, I bought shares in a large company that pays dividends quarterly. I earn income regularly while my shares can also increase in value.
Exactly. And creating a balanced portfolio is important. If I have $10,000, I might put $5,000 in blue chip stocks, $3,000 in bonds, and $2,000 in money market tools. If the stock market falls, the bonds and money market investments provide stability.
Yes, and long-term investing helps too. Even during a bear market, patient investors often see their investments grow over several years. For example, someone who bought shares of a strong company 5 years ago may have doubled their money today.
And diversification reduces risk. By spreading money across stocks, bonds, and money market instruments, you are protected if one investment loses value. For instance, during last year's downturn, my stocks fell slightly, but bonds and treasury bills kept my portfolio steady.
Another important concept is compound interest. This is when the money you earn also starts earning money. For example, if you invest $1,000 at 10% annual interest, in 1 year you have $1,100. Next year, you earn interest not just on $1,000 but on $1,100, which keeps growing. Over many years, compound interest can turn small savings into a large amount.
That's very true. But we also have to think about inflation. Inflation means that prices of goods and services rise over time. If inflation is 5% and your savings only earn 3%, your money is actually losing value. That's why investments that beat inflation, like stocks or real estate, are important in the long run.
Mutual funds are another way people invest. Instead of buying individual stocks, you pool your money with other investors and professionals manage it. They spread the money across many stocks and bonds, making it safer for beginners.
Yes, and similar to mutual funds are ETFs, or exchange-traded funds. ETFs also hold collections of stocks or bonds, but they trade on the stock exchange like regular shares. They are easy to buy and sell, and usually have lower fees than mutual funds.
We should also mention retirement savings. Many people use retirement accounts like 401k in the US or pension plans in other countries. These accounts encourage saving for the future and often provide tax benefits. Starting early makes a huge difference because of compound interest.
Another financial topic is credit scores. A credit score shows how trustworthy you are in borrowing money. If you pay your bills on time and manage loans wisely, your score goes up. A good credit score helps you get loans at lower interest rates, which saves money.
And don't forget risk management. Investors always balance risk and reward. High-risk investments can give higher returns, but they can also cause bigger losses. Safe investments give lower returns, but protect your money. A smart investor mixes both.
Yes, and that's where financial planning comes in. Planning means setting goals like buying a home, paying for education, or retiring comfortably, and then choosing investments that match those goals. Without a plan, people often make random choices and regret later. Managing money is a skill anyone can learn. Balancing risk and growth, planning for emergencies, and understanding the markets makes your money work for you. For example, a balanced approach can help you save for a house, education, or retirement while minimizing stress.
Exactly. So, by learning these terms and concepts, portfolio, yield, dividend, liquidity, bull market, bear market, portfolios, bonds, liquidity, dividends, compound interest, inflation, mutual funds, ETFs, credit scores, and retirement planning, you can both improve your English and understand money better. Today we covered a lot: the stock market, money market, bull and bear markets, portfolios, bonds, liquidity, dividends, compound interest, inflation, and financial planning. I hope this helps you understand money better and practice English at the same time.
Thank you for listening. Remember, managing money wisely takes patience and planning. Keep learning, and your future will be more secure.